In Unit 3, you learned about using financial statements and ratio calculations to determine the health and future financial needs of the business organization, and are now able to describe the components of key financial statements and how these statements are used in making business decisions. You are also able to calculate financial ratios to determine the economic health of an organization and can explain how financial forecasting helps the organization predict future financial needs. In Unit 4, you will learn about how interest rates, time value of money, and the principles of risk and return help to inform financial business decisions and reduce risk. You will identify fundamentals of interest rates, required return, and inflation in a financial setting to inform a business decision, and you will learn more about how to calculate the future and present value of money to inform a financial decision. In the last module in this unit, you will learn about the ways to reduce an organization's risk in order to achieve long-term financial goals, compute rates of return, and describe their use in making financial decisions. Defining required rate of return, RRR. The required rate of return, RRR, is the minimum annual percentage earned by an investment that will induce individuals or companies to put money into a particular security or project. Key points: the first building block for assessing a required return is the risk-free interest rate. Determine the difference between simple and compound interest. Interest is money that you pay in order to keep money. Interest rates directly affect lending and borrowing because higher interest rates make servicing loans more costly. Supply and demand impact affect interest rates when the current level of liquid money, supply, coordinates with the total demand for liquid money, demand, to help determine interest rates. Key terms: required rate of return, the minimum annual percentage earned by an investment that will induce individuals or companies to put money into a particular security or project. Yield commonly refers to the dividend, interest, or return the investor receives from a security like a stock or bond, and is usually reported as an annual figure. Interest rates, the cost of borrowing money, generally refers to the interest charged by a lender, such as a bank on a loan. Annual percentage rate, APR, the annual rate charged for borrowing or earned through an investment, expressed as a percentage that represents the actual yearly cost of funds over the term of a loan. Effective APR, the amount you pay after fees and compound interest have been added to the charges. Required rate of return investors come in many forms. They may be individuals who invest in corporate stocks, a speculator investing in a Texas oil well, retirement funds that invest in bonds, partnerships investing in apartment buildings, or corporations investing in productive projects. One thing all these investors have in common is their desire to increase their wealth, which is done by identifying projects whose value is expected to exceed their cost. If we invest $100 today in a project that produces cash flows worth $125 in today's terms, then we increase our wealth by $25. The basic formula for estimating the value of an investment is found by discounting the expected future cash flows, CFs, back to today's equivalent value, V0, at a rate of return that is appropriate given the investment's risk. In other words, at the investor's required return, RR, in the following equation. One part of the formula that hasn't been covered is how to estimate the required return that is appropriate to use as the discount rate in the valuation calculation. The building blocks of the required return investors are assumed to be rational and risk-averse. Because they are mostly rational, investors will give up control of their money for a period of time by investing only if they expect to increase their wealth. Therefore, investors have an almost instinctual return requirement as they invest. For example, rational investors would always want to earn at least the risk-free rate of return when investing in some security or project. Otherwise, they would be settling for a return lower than what they could be assured of by simply depositing the funds in a savings account that is guaranteed by both the bank and the government, though the FDIC, Federal Deposit Insurance Corporation. So we believe that the first building block for assessing a required return is the risk-free interest rate. In the study of finance, the risk-free rate is usually considered to be the rate of U.S. Treasury obligations, called T-bills, short-term obligations, and T-bonds, generally considered to be obligations with 10 or 30-year maturities. For most investments, however, the risk-free rate is only the first component of the required return. Virtually all investments have some risk associated with them, so investors also require what is known as a risk premium to compensate them for this risk exposure. Recall that we assume that investors are risk-averse, which implies that to bear risk, they require compensation in order to subject themselves to distasteful uncertainty. Now we have the two fundamental building blocks of the required return for an investment: the risk-free return and a risk premium. The financial markets and required return of financial market is a broad term that applies to any marketplace where buyers and sellers participate in the trade of assets, such as stocks, equities, debt, bonds, currencies, the US dollar, the British pound, the Japanese yen, commodities, gold, silver, agricultural futures, and derivatives, options, and futures. Trillions of dollars are traded daily in both physical and online exchanges. Hundreds of thousands of people participate directly in the financial markets, in a variety of roles, in the U.S. alone. In looking to make a return, in seeking to make money, individuals in these markets perform the important role of price discovery of the assets they trade. Ask yourself, how much is a share of Apple stock worth? How much is a bond issued by Hewlett-Packard Company worth? How much is my house worth? The answer is, the worth of any item is whatever price the owner of that asset is willing to sell it for, and whatever price a prospective buyer is willing to buy it for. Now, picture thousands of buyers and sellers trading financial assets and making decisions about buying and selling. These decisions are based on their interpretation of information in the economy, the political, legal, and regulatory environments affecting the specific assets being traded, and financial information that is released by the company or government entity that has issued the security that is being traded. Prices of financial assets rise and fall based on the cumulative supply and demand of the particular asset, as expressed by the actions of buyers and sellers. Implicit in the prices of financial securities are the returns that are required by investors. Let's look at the example of a bond from a fictional corporation called M&M Company. The M&M bond has a 10-year term and pays a semi-annual coupon equal to 4% of its face value. It is traded in the bond markets for a price of $97.50, which works out to a yield of 4.2%. That means that buyers, investors, are requiring a return of 4.2% on the M&M bond. The price of the M&M bond is likely to change frequently, sometimes every few minutes. For example, if an employment report issued by the U.S. Department of Commerce is better than expected, bond traders will likely interpret this information as meaning the Federal Reserve will raise short-term interest rates. Such a rise in interest rates will have a negative effect on the price of the M&M bond. The M&M bond starts trading at a price of $96.75, and its yield increases to 4.27%. Buyers, investors, are now requiring a return of 4.27% on the M&M bond. This same phenomenon happens with all assets that are traded in the financial markets, whether it's from bonds, stocks, currencies, money market instruments, commodities, or derivatives. Price discovery, which is identical to the determination of required return, occurs as part of the process of buying and selling. Rate of return is also known as yield and interest rate. Video, Intro to Compound Interest. Yield versus Interest Rate, 637. View the Introduction to Compound Interest video. This resource provides a helpful introduction to compounding interest and will show you how quickly compounds. Compound Interest Introduction Interest and Debt Finance and Capital Markets, Khan Academy. Yield versus Interest Rate. What's the difference? Yield versus interest rate. An overview. Both yield and interest rates are important terms for any investor to understand, especially those investors with fixed income securities such as bonds or CDs. Yield refers to the earnings from an investment over a specific period. It includes investor earnings, such as interest and dividends received by holding particular investments. Yield is also the annual profit that an investor receives for an investment. The interest rate is the percentage charged by a lender for a loan. Interest rate is also used to describe the amount of regular return an investor can expect from a debt instrument, such as a bond or certificate of deposit, CD. Ultimately, interest rates are reflected in the yield that an investor in debt can expect to earn. Yield is the annual net profit that an investor earns on an investment. The interest rate is the percentage charged by a lender for a loan. The yield on new investments in debt of any kind reflects interest rates at the time they are issued. Yield refers to the return that an investor receives from an investment, such as a stock or a bond. It is usually reported as an annual figure. In bonds, as in any investment in debt, the yield is comprised of payments of interest known as the coupon. In stocks, the term yield does not refer to profit from the sale of shares. It indicates the return in dividends for those who hold the shares. Dividends are the investor's share of the company's quarterly profit. For example, if PepsiCo PAP pays its shareholders a quarterly dividend of 50 cents and the stock price is $50, the annual dividend yield would be 4%. If the stock price doubles to $100 and the dividend remains the same, then the yield is reduced to 2%. In bonds, the yield is expressed as yield to maturity, YTM. The yield to maturity of a bond is the total return that the bond's holder can expect to receive by the time the bond matures. The yield is based on the interest rate that the bond issuer agrees to pay. The interest rate on any loan is the percentage of the principal that a lender will charge annually until the loan is repaid. In consumer lending, it is typically expressed as the annual percentage rate, APR, of the loan. As an example of interest rates, say you go into a bank to borrow $1,000 for 1 year to buy a new bicycle, and the bank quotes you a 10% interest rate on your loan. In addition to paying back the $1,000, you would pay another $100 in interest on the loan. That example assumes the calculation using simple interest. If the interest is compounded, you will pay a little more over a year and a lot more over many years. Compounding interest is a sum calculated on the principal due plus any accumulated interest up to the date of compounding. This is an especially important concept for both savings accounts and loans that use compound interest in their calculations. Interest rate is also a common term used in debt securities. When an investor buys a bond, they become the lender to a corporation or the government selling the bond. Here, the interest rate is also known as the coupon rate. This rate represents the regular, periodic payment based on the borrowed principal that the investor receives in return for buying the bond. Coupon rates can be real, nominal, and effective and impact the profit an investor may realize by holding fixed-income debt security. The nominal rate is the most common rate quoted in loans and bonds. This figure is the value based on the principal that the borrower receives as a reward for lending money for others to use. The real interest rate is the value of borrowing that removes the effect of inflation and has a basis on the nominal rate. If the nominal rate is 4% and inflation is 2%, the real interest rate will be 2%, 4%, 2% equals 2%. When inflation rises, it can push the real rate into the negative. Investors use this figure to help them determine the actual return on fixed-income debt securities. The final type of interest rates is the effective rate. This rate includes the compounding of interest. Loans or bonds that have more frequent compounding will have a higher effective rate. For example, a lender might charge an interest rate of 10% for a 1-year loan of $1,000. At the end of the year, the yield on the investment for the lender would be $100, or 10%. If the lender incurred any costs in making the loan, those costs would reduce the yield on the investment. Special considerations current interest rates underpin the yield on all borrowing, from consumer loans to mortgages and bonds. They also determine how much an individual makes for saving money, whether in a simple savings account, a CD, or an investment-quality bond. The current interest rate determines the yield that a bond will bear at the time it is issued. It also determines the yield a bank will demand when a consumer seeks a new car loan. The precise rates will vary, of course, depending on how much the bond issuer or the bank lender wants the business and the creditworthiness of the borrower. Interest rates constantly fluctuate, with the most important factor being the guidance of the Federal Reserve, which periodically issues a target range for a key interest rate. Board of Governors of the Federal Reserve System. Open market operations. All other lending rates are essentially extrapolated from that key interest rate. Video. Annual percentage rate, APR, 711. View the annual percentage rate, APR, and effective APR. This resource provides a clear explanation of the difference between APR and effective APR. Annual percentage rate, APR, and effective APR. Finance and Capital Markets Khan Academy. Simple versus compound interest, 955. View the Introduction to Interest video. This resource provides a helpful introduction to what interest is and compares simple versus compound interest. Introduction to Interest and Debt Finance and Capital Markets Khan Academy. Defining market interest rates A market interest rate is the rate at which interest is paid by a borrower for the use of money that they borrow from a lender in the market. Market interest rates are mostly driven by inflationary expectations, alternative investments, risk of investment, and liquidity preference. Key points: a market interest rate is the rate at which interest is paid by a borrower for the use of money that they borrow from a lender in the market. Economists generally agree that the interest rates yielded by any investment take into account the risk-free cost of capital, inflationary expectations, the level of risk in the investment, and the costs of the transaction. Key terms: abscond, to flee, to withdraw from; inflation, an increase in the general level of prices or in the cost of living; interest rate risk, the potential for loss that arises for bond owners from fluctuating interest rates; liquidity, availability of cash over the short term, ability to service short-term debt; factors influencing market interest rates: deferred consumption, when money is loaned, the lender delays spending the money on consumption goods. According to time preference theory, people prefer goods now to goods later. In a free market, there will be a positive interest rate. Inflationary expectations. Most economies generally exhibit inflation, meaning a given amount of money buys fewer goods in the future than it will now. The borrower needs to compensate the lender for this. If the inflationary expectation goes up, then so does the market interest rate, and vice versa. Alternative investments. The lender has a choice between using his money in different investments. If he chooses one, he forgoes the returns from all the others. Different investments effectively compete for funds, boosting the market interest rate up. Risks of investment. There is always a risk that the borrower will abscond, die, go bankrupt, or otherwise default on the loan. This means that a lender generally charges a risk premium to ensure that he is compensated for those that fail across all his investments. The greater the risk, the higher the market interest rate will get. Liquidity preference. People prefer to have their resources available in a form that can immediately be exchanged, rather than a form that takes time or money to realize. If people are willing to hold more money in hands for convenience, the money supply will contract, increasing the market interest rate. Market impact. There is a market for investments which ultimately includes the money market, bond market, stock market, and currency market, as well as retail financial institutions like banks. Exactly how these markets function are sometimes complicated. However, economists generally agree that the interest rates yielded by any investment take into account the risk-free cost of capital, inflationary expectations, the level of risk in the investment, and the costs of the transaction. This rate incorporates the deferred consumption and alternative investments elements of interest. Liquidity premium, reflecting the perceived difficulty of converting the asset into money and thus into goods. Defining term structure of interest rates describes how rates change over time. Key points: term structure of interest rates is often referred to as the yield curve. The expectation hypothesis of the term structure of interest rates is the proposition that the long-term rate is determined by the market's expectation for the short-term rate plus a constant risk premium. The liquidity premium theory asserts that long-term interest rates not only reflect investors' assumptions about future interest rates, but also include a premium for holding long-term bonds. In the segmented market hypothesis, financial instruments of different terms are not substitutable. Therefore, supply and demand in the markets for short-term and long-term instruments is determined largely independently. Key terms: liquidity premium, a term used to explain a difference between two types of financial securities, stocks, that have all the same qualities except liquidity. Premium, the price above par value at which a security is sold. Premium bond, a debt instrument bought at a price above par value. Risk premium, a risk premium is the minimum amount of money by which the expected return on a risky asset must exceed the known return on a risk-free asset or the expected return on a less risky asset in order to induce an individual to hold the risky asset rather than the risk-free asset. Term structure of interest rates, the relationship between the interest on a debt contract and the maturity of the contract. Yield curve, a line that plots the interest rates at a set point in time of bonds having equal credit quality but differing maturity dates. Term structure is a phrase used to describe how a given quantity or variable changes with time. In the case of bonds, time to maturity, or terms, vary from short-term, usually less than a year, to long-term 10, 20, 30, 50 years, etc. term structure of interest rates is often referred to as the yield curve. Video. Introduction to the Yield Curve, 956. View Introduction to the Yield Curve video. This resource provides a helpful introduction to the concept of the risk-free yield curve. Introduction to the Yield Curve Stocks and Bonds Finance and Capital Markets Khan Academy in Finance. The yield curve is a curve showing several yields or interest rates across different contract lengths, 2-month, 2-year, 20-year, etc., for a similar debt contract. The curve shows the relationship between the interest rate, or cost of borrowing, and the time to maturity, known as the term, off the debt for a given borrower in a given currency. The curve allows an interest rate pattern to be determined, which can then be used to discount cash flows appropriately. Unfortunately, most bonds carry coupons, so the term structure must be determined using the prices of these securities. There are three main economic theories attempting to explain different term structures of interest rates. Two of the theories are extreme positions, while the third attempts to find a middle ground between two extremes. The expectation hypothesis of the term structure of interest rates is the proposition that the long-term rate is determined by the market's expectation for the short-term rate plus a constant risk premium. Shortcomings of the expectations theory is that it neglects the risks inherent in investing in bonds, namely interest rate risk and reinvestment rate risk. The liquidity premium theory asserts that long-term interest rates not only reflect investors' assumptions about future interest rates, but also include a premium for holding long-term bonds. Investors prefer short-term bonds to long-term bonds. This is called the term premium or the liquidity premium. This premium compensates investors for the added risk of having their money tied up for a longer period, including the greater price uncertainty. Because of the term premium, long-term bond yields tend to be higher than short-term yields, and the yield curve slopes upward. Long-term yields are also higher not just because of the liquidity premium, but also because of the risk premium added by the risk of default from holding a security over the long term. In the segmented market hypothesis, financial instruments of different terms are not substitutable. As a result, the supply and demand in the markets for short-term and long-term instruments is determined largely independently. Prospective investors decide in advance whether they need short-term or long-term instruments. If investors prefer their portfolio to be liquid, they will prefer short-term instruments to long-term instruments. Therefore, the market for short-term instruments will receive a higher demand. Higher demand for the instrument implies higher prices and lower yield. This explains the stylized fact that short-term yields are usually lower than long-term yields. This theory explains the predominance of the normal yield curve shape. However, because the supply and demand of the two markets are independent, this theory fails to explain the observed fact that yields tend to move together, i.e., upward and downward shifts in the curve. Cost-push inflation versus demand-pull inflation. What's the difference? Cost-push inflation versus demand-pull inflation. An overview: there are four main drivers behind inflation. Among them are cost-push inflation, or the decrease in the aggregate supply of goods and services stemming from an increase in the cost of production, and demand-pull inflation, or the increase in aggregate demand, categorized by the four sections of the macroeconomy: households, business, governments, and foreign buyers. The two other contributing factors to inflation include an increase in the money supply of an economy and a decrease in the demand for money. Inflation is the rate at which the general price level of goods and services rises. This, in turn, causes a drop in purchasing power. This is not to be confused with the change in the prices of individual goods and services, which rise and fall all the time. Inflation happens when prices rise across the economy to a certain degree. Stemming from an increase in the cost of production. Demand-pull inflation is the increase in aggregate demand, categorized by the four sections of the macroeconomy: households, business, governments, and foreign buyers. An increase in the cost of raw materials or labor can contribute to cost-pull inflation. Demand-pull inflation can be caused by an expanding economy, increased government spending, or overseas growth. Cost-push inflation aggregate supply is the total volume of goods and services produced by an economy at a given price level. When the aggregate supply of goods and services decreases because of an increase in production costs, it results in cost-push inflation. Cost-push inflation means prices have been pushed up, by increases in the costs of any of the four factors of production: labor, capital, land, or entrepreneurship, when companies are already running at full production capacity. Companies cannot maintain profit margins by producing the same amounts of goods and services when their costs are higher and their productivity is maximized. 1. The price of raw materials may also cause an increase in costs. This may occur because of a scarcity of raw materials, an increase in the cost of labor to produce the raw materials, or an increase in the cost of importing raw materials. The government may also increase taxes to cover higher fuel and energy costs, forcing companies to allocate more resources to paying taxes. In order to compensate, the increase in costs is passed on to consumers, causing a rise in the general price level, inflation. For cost-push inflation to occur, demand for goods must be static or inelastic. That means demand must remain constant while the supply of goods and services decreases. One example of cost-push inflation is the oil crisis of the 1970s. The price of oil was increased by OPEC countries, while demand for the commodity remained the same. As the price continued to rise, the cost of finished goods also increased, resulting in inflation. Let's take a look at how cost-push inflation works using this simple price-quantity graph. The graph below shows the level of output that can be achieved at each price level. As production costs increase, aggregate supply decreases from AS1 to AS2, given production is at full capacity, causing an increase in the price level from P1 to P2. The rationale behind this increase is, for companies to maintain or increase profit margins, they will need to raise the retail price paid by consumers, thereby causing inflation. Demand pull inflation occurs when there is an increase in aggregate demand, categorized by the four sections of the macroeconomy: households, businesses, governments, and foreign buyers. When concurrent demand for output exceeds what the economy can produce, the four sectors compete to purchase a limited amount of goods and services. That means the buyers bid prices up again and cause inflation. This excessive demand, also referred to as too much money chasing too few goods, usually occurs in an expanding economy. In Keynesian economics, an increase in aggregate demand is caused by a rise in employment, as companies need to hire more people to increase their output. The increase in aggregate demand that causes demand pull inflation can be the result of various economic dynamics. For example, an increase in government spending can increase aggregate demand, thus raising prices. Another factor can be the depreciation of local exchange rates, which raises the price of imports and, for foreigners, reduces the price of exports. As a result, the purchasing of imports decreases while the buying of exports by foreigners increases. This raises the overall level of aggregate demand, assuming aggregate supply cannot keep up with aggregate demand as a result of full employment in the economy. 6. Rapid overseas growth can also ignite an increase in demand as more exports are consumed by foreigners. Finally, if a government reduces taxes, households are left with more disposable income in their pockets. This, in turn, leads to an increase in consumer confidence that spurs consumer spending. Looking again at the price-quantity graph, we can see the relationship between aggregate supply and demand. If aggregate demand increases from AD1 to AD2, in the short run, this will not change aggregate supply. Instead, it will cause a change in the quantity supplied, represented by a movement along the AS curve. The rationale behind this lack of shift in aggregate supply is that aggregate demand tends to react faster to changes in economic conditions than aggregate supply. As companies respond to higher demand with an increase in production, the cost to produce each additional output increases, as represented by the change from P1 to P2. That's because companies would need to pay workers more money, overtime, and slash or invest in additional equipment to keep up with demand. Just like cost-push inflation, demand-pull inflation can occur as companies pass on the higher cost of production to consumers to maintain their profit levels. Special considerations: there are ways to counter both cost-push inflation and demand-pull inflation, which is through the implementation of different policies. To counter cost-push inflation, supply-side policies need to be enacted with the goal of increasing aggregate supply. 7. To increase aggregate supply, taxes can be decreased and central banks can implement contractionary monetary policies, achieved by increasing interest rates. 8. Countering demand-pull inflation would be achieved by the government and central bank implementing contractionary monetary and fiscal policies. This would include increasing the interest rate, the same as countering cost-push inflation because it results in a decrease in demand, decreasing government spending, and increasing taxes, all measures that would reduce demand. Understand the different types of inflation at its most basic level. Inflation is a general increase in prices across the economy and is well known to all of us. After all, who among us has not reminisced about cheap rents of the past or how little lunch used to cost? And who has not noticed prices on everything from milk to movie tickets creeping upward? In this article, we explore the major types of inflation and touch upon the competing explanations offered by different economic schools. Key lays in which the overall level of prices for various goods and services in an economy rises over a period of time. As a result, money loses value because it no longer buys as much as it did in previous times. The purchasing power of a country's currency declines. Central banks look to maintain mild inflation of as much as 3% to help spur economic growth, but inflation considerably beyond that level could lead to brutal situations such as hyperinflation or stagflation. Hyperinflation is a period of fast-rising inflation. Stagflation is a period of spiking inflation plus slow economic growth and high unemployment. Deflation is when prices drop significantly due to too large a money supply or a slump in consumer spending. Lower costs mean companies earn less and may institute layoffs. Stagflation and hyperinflation. Two extremes, although as consumers we may hate rising prices, many economists believe a moderate degree of inflation is healthy for a nation's economy. Typically, central banks aim to maintain inflation around 2% to 3%. Increases in inflation significantly beyond this range can lead to fears of possible hyperinflation, a devastating scenario in which inflation rises rapidly out of control. There have been several notable instances of hyperinflation throughout history. The most famous example is Germany during the early 1920s, when inflation reached 30,000% per month. Zimbabwe offers an even more extreme example. According to research by Steve H. Hank and Alex K. F. Kwok, monthly price increases in Zimbabwe reached an estimated 79,600 million% in November 2008. Stagflation, a time of economic stagnation combined with inflation, can also wreak havoc. This type of inflation is a witch's brew of economic adversity, combining poor economic growth, high unemployment, and severe inflation all in one. Although recorded instances of stagflation are rare, the phenomenon occurred as recently as the 1970s when it gripped the United States and the United Kingdom, much to the dismay of both nations' central banks. Stagflation poses a particularly daunting challenge to central banks because it increases the risks associated with fiscal and monetary policy responses. Whereas central banks can usually raise interest rates to combat high inflation, doing so in a period of stagflation could risk further increasing unemployment. Conversely, central banks are limited in their ability to decrease interest rates in times of stagflation because doing so could cause inflation to rise even further. As such, stagflation acts as a kind of checkmate against central banks, leaving them with no moves left to make. Stagflation is arguably the most difficult type of inflation to manage. Negative inflation, also known as deflation. Negative inflation occurs when prices drop for various reasons. Having a smaller money supply increases the value of money, which in turn decreases prices. A reduction in demand, either because there is too large of a supply or a reduction in consumer spending, can also cause negative inflation. Deflation may seem like a good thing because it reduces the prices of goods and services, thus making them more affordable, but it can negatively affect the economy in the long run. When businesses make less money on their products, they are forced to cut costs, which often means laying off or terminating employees, thereby increasing unemployment. What causes inflation? We can define inflation with relative ease, but the question of what causes inflation is significantly more complex. Although numerous theories exist, arguably the two most influential schools of thought on inflation are those of Keynesian and monetarist economics. Keynesian economists argue inflation results from economic pressures such as the increased cost of production and look to government intervention as a solution. Monetarist economists believe inflation stems from the expansion of the money supply and that central banks should maintain stable growth for the money supply in line with GDP. Keynesian economics, the Keynesian school of thought derived its name and intellectual foundation from British economist John Maynard Keynes, 1883 to 1946. 5. Although its modern interpretation continues to evolve, Keynesian economics is broadly characterized by its emphasis on aggregate demand as the prime mover of economic development. As such, adherents of this tradition advocate government intervention through fiscal and monetary policy as a means of achieving desired economic outcomes, such as increasing employment or dampening the volatility of the business cycle. The Keynesian school believes inflation results from economic pressures, such as rising costs of production or increases in aggregate demand. Specifically, they distinguish between two broad types of inflation: cost-push inflation and demand-pull inflation. Cost-push inflation results from general increases in the costs of the factors of production. These factors, which include capital, land, labor, and entrepreneurship, are the necessary inputs required to produce goods and services. When the cost of these factors rise, producers wishing to retain their profit margins must increase the price of their goods and services. When these production costs rise on an economy-wide level, it can lead to increased consumer prices throughout the whole economy as producers pass on their increased costs to consumers. Consumer prices, in effect, are thus pushed up by production costs. Demand-pull inflation results from an excess of aggregate demand relative to aggregate supply. For example, consider a popular product where demand for the product outstrips supply. The price of the product would increase. The theory in demand-pull inflation is if aggregate demand exceeds aggregate supply, prices will increase economy-wide. Monetarist economics monetarism is not explicitly linked to a particular founding figure, but is closely associated with the American economist Milton Friedman, 1912 to 2006. As its name suggests, monetarism is concerned principally with the role of money in influencing economic developments. Specifically, it is concerned with the economic effects of changes to the money supply. Adherents of the monetarist school are more skeptical than their Keynesian counterparts regarding the effectiveness of government intervention in the economy. Monetarists caution such interventions risk doing more harm than good. Perhaps the most famous such criticism was made by Friedman himself in his influential publication, co-written with Anna J. Schwartz, A Monetary History of the United States, 1867 to 1960, in which Friedman and Schwartz argued that policy decisions of the Federal Reserve inadvertently deepened the severity of the Great Depression. 7. Based on this skepticism, Friedman suggested central banks should concern themselves with maintaining a stable rate of growth for the nation's money supply in line with the gross domestic product, GDP of 8 Federal Reserve Bank of Cleveland. Milton Friedman, Teacher, 1912 to 2006, pages 1 to 3. Download PDF. Monetarists. It's all about the money. Monetarists have historically explained inflation as a consequence of an expanding money supply. The monetarist view is perfectly encapsulated by Friedman's remark that inflation is always and everywhere a monetary phenomenon. According to this view, the principal factor underlying inflation has little to do with things like labor, materials costs, or consumer demand. Instead, it is all about the supply of money. 9. At the heart of this perspective is the quantity theory of money, which posits the relationship between the money supply and inflation is governed by the relationship implicit in this equation is the belief that if the velocity of money and the volume of transactions is constant, an increase or decrease in the supply of money will cause a corresponding increase or decrease in the average price level. Given that the velocity of money and the volume of transactions are in reality never constant, it follows that this relationship is not as straightforward as it may initially seem. Nevertheless, this equation serves as an effective model of the monetarist belief that the expansion of the money supply is the principal cause of inflation. The bottom line, inflation comes in many forms, from historically extreme cases of hyperinflation and stagflation to the 5-cent and 10-cent increases we hardly notice. Economists from the Keynesian and monetarist schools disagree on the root causes of inflation, underscoring the fact that inflation is a far more complex phenomenon than one might initially assume. Defining opportunity cost: the cost of money is the opportunity cost of holding money instead of investing it, depending on the rate of interest. Key points: the concept of the cost of money has its basis, as does the subject of finance in general, in the time value of money. The time value of money refers to the fact that a dollar in hand today is worth more than a dollar promised at some future time. The trade-off between money now, holding money, and money later, investing, depends on, among other things, the rate of interest you can earn by investing. Therefore, interest is the cost of money. Key terms: interest rate, the percentage of an amount of money charged for its use per some period of time. It can also be thought of as the cost of not having money for one period, or the amount paid on an investment per year. Opportunity cost, the cost of an opportunity foregone and the loss of the benefits that could be received from that opportunity, the most valuable foregone alternative. Opportunity cost formula, calculation, and what it can tell you. What is opportunity cost? Opportunity costs represent the potential benefits that an individual, investor, or business misses out on when choosing one alternative over another. Because opportunity costs are unseen by definition, they can be easily overlooked. Understanding the potential missed opportunities when a business or individual chooses one investment over another allows for better decision-making. KETAKAWAY's opportunity cost is the foregone benefit that would have been derived from an option not chosen. To properly evaluate opportunity costs, the costs and benefits of every option available must be considered and weighed against the others. Considering the value of opportunity costs can guide individuals and organizations to more profitable decision-making. Opportunity cost is a strictly internal cost used for strategic contemplation. It is not included in accounting profit and is excluded from external financial reporting. Examples of opportunity cost include investing in a new manufacturing plant in Los Angeles as opposed to Mexico City, deciding not to upgrade company equipment, or opting for the most expensive product packaging option over cheaper options. The formula for calculating an opportunity cost is simply the difference between the expected returns of each option. Consider a company is faced with the following two mutually exclusive options. Option A: invest excess capital in the stock market to potentially earn capital gains. Option B: invest excess capital back into the business for new equipment to increase production efficiency. Assume the expected return on investment, ROI, in the stock market is 12% over the next year, and your company expects the equipment update to generate a 10% return over the same period. The opportunity cost of choosing the equipment over the stock market is 2%, 12%, 10%. In other words, by investing in the business, the company would forego the opportunity to earn a higher return. While financial reports do not show opportunity costs, business owners often use the concept to make educated decisions when they have multiple options before them. Bottlenecks, for instance, often result in opportunity costs. What opportunity cost can tell you? Opportunity cost analysis plays a crucial role in determining a business's capital structure. A firm incurs an explicit cost of issuing both debt and equity capital because it must compensate lenders and shareholders for the risk of investment, yet each option also carries an opportunity cost. Funds used to make payments on loans, for example, cannot be invested in stocks or bonds, which offer the potential for investment income. The company must decide if the expansion made by the leveraging power of debt will generate greater profits than it could make through investments. A firm tries to weigh the costs and benefits of issuing debt and stock, including both monetary and non-monetary considerations, to arrive at an optimal balance that minimizes opportunity costs. Because opportunity cost is a forward-looking consideration, the actual rate of return, or ROR, for both options is unknown today, making this evaluation tricky in practice. It is important to compare investment options that have a similar risk. Comparing a treasury bill, which is virtually risk-free, to investment in a highly volatile stock can cause a misleading calculation. Both options may have expected returns of 5%, but the U.S. government backs the ROR of the T-bill, while there is no such guarantee in the stock market. While the opportunity cost of either option is 0%, the T-bill is the safer bet when you consider the relative risk of each investment. Comparing investments when assessing the potential profitability of various investments, businesses look for the option that is likely to yield the greatest return. Often, they can determine this by looking at the expected ROR for an investment vehicle. However, businesses must also consider the opportunity cost of each alternative option. One assumed that, given $20,000 of available funds, a business must choose between investing funds in securities or using it to purchase new machinery. No matter which option the business chooses, the potential profit that it gives up by not investing in the other option is the opportunity cost. If the business goes with the first option at the end of the first year, its investment will be worth $22,000. The formula to calculate ROR is current value, initial value, slash current value x 100. In this example, $22,000, $20,000, slash $20,000, x 100 equals 10%, so the ROAR on the investment is 10%. For the purposes of this example, let's assume it would net 10% every year after as well. At a 10% ROAR, with compounding interest, the investment will increase by $2,000 in year 1, $2,200 in year 2, and $2,420 in year 3. Alternatively, if the business purchases a new machine, it will be able to increase its production of widgets. The machine setup and employee training will be intensive, and the new machine will not be up to maximum efficiency for the first couple of years. Let's assume it would net the company an additional $500 in profits in the first year, after accounting for the additional expenses for training. The business will net $2,000 in year 2 and $5,000 in all future years. Since the company has limited funds to invest in either option, it must make a choice. According to this, the opportunity cost for choosing the securities makes sense in the first and second years. However, by the third year, an analysis of the opportunity cost indicates that the new machine is the better option, $500 plus $2,000 plus $5,000, $2,000, $2,200, $2,420 equals $880. The most expensive pizza ever. One of the most famous examples of opportunity cost is a 2010 exchange of Bitcoin for pizza. 2. The opportunity cost of exchanging the 10,000 Bitcoins for 2 large pizzas peaked at almost $700 million based on Bitcoin's 2022 all-time high price. 3. The difference between opportunity cost and sunk cost. A sunk cost is money already spent in the past, while opportunity cost is the potential returns not earned in the future on an investment because the capital was invested elsewhere. When considering opportunity cost, any sunk costs previously incurred are ignored unless there are specific variable outcomes related to those funds. Buying 1,000 shares of company at $10 a share, for instance, represents a sunk cost of $10,000. This is the amount of money paid out to invest, and getting that money back requires liquidating stock. The opportunity cost instead asks where that $10,000 could have been put to better use. From an accounting perspective, a sunk cost also could refer to the initial outlay to purchase an expensive piece of heavy equipment, which might be amortized over time, but which is sunk in the sense that you won't be getting it back. 4. An opportunity cost would be to consider the foregone returns possibly earned elsewhere when you buy a piece of heavy equipment with an expected ROI of 5% versus one with an ROI of 4%. Again, an opportunity cost describes the returns that one could have earned if the money were instead invested in another instrument. Thus, while 1,000 shares in Company A eventually might sell for $12 a share, netting a profit of $2,000, Company B increased in value from $10 a share to $15 during the same period. In this scenario, investing $10,000 in Company A returned $2,000, while the same amount invested in Company B would have returned a larger $5,000. The $3,000 difference is the opportunity cost of choosing Company A over Company B. As an investor who has already put money into investments, you might find another investment that promises greater returns. The opportunity cost of holding the underperforming asset may rise to the point where the rational investment option is to sell and invest in the more promising investment. Opportunity cost and risk in economics. Risk describes the possibility that an investment's actual and projected returns are different and that the investor loses some or all of the principal. Opportunity cost concerns the possibility that the returns of a chosen investment are lower than the returns of a foregone investment. The key difference is that risk compares the actual performance of an investment against the projected performance of the same investment, while opportunity cost compares the actual performance of an investment against the actual performance of another investment. Still, one could consider opportunity cost when deciding between two risk profiles. If investment A is risky but has an ROI of 25%, while investment B is far less risky but only has an ROI of 5%, even though investment A may succeed, it may not. If it fails, then the opportunity cost of going with option B will be salient. Therefore, decision makers rely on much more information than just looking at just opportunity cost dollar amounts when comparing options. In 1962, a little-known band called the Beatles auditioned for Decca Records. The label decided against signing the band. This decision would have been made because the opportunity cost to sign them did not outweigh the opportunity cost to pass on them. 5. Economic profit and accounting profit. Opportunity cost is used to calculate different types of company profit. The most common type of profit analysts are familiar with is accounting profit. Accounting profit is the net income calculation often stipulated by generally accepted accounting principles, GAAP. Only explicit, real costs are subtracted from total revenue. Companies or analysts can future manipulate accounting profit to arrive at economic profit. The difference between the calculation of the two is economic profit includes opportunity cost as an expense. This theoretical calculation can then be used to compare the actual profit of the company to what the theoretical profit would have been. Economic profit and any other calculation above that considers opportunity cost is strictly an internal value used for strategic decision-making. There are no regulatory bodies that govern public reporting of economic profit or opportunity cost. Whereas accounting profit is heavily dictated by reporting rules and frameworks, economic profit factors in vague assumptions and estimates from management that do not have IRS, SEC, or FASB oversight. Example of opportunity cost: before making big decisions like buying a home or starting a business, you probably will scrupulously research the pros and cons of your financial decision. But most day-to-day choices aren't made with a full understanding of the potential opportunity costs. When feeling cautious about a purchase, for instance, many people will check the balance of their savings account before spending money. But they often won't think about the things that they must give up when they make that spending decision. The problem comes up when you never look at what else you could do with your money or buy things without considering the lost opportunities. Having takeout for lunch occasionally can be a wise decision, especially if it gets you out of the office for a much-needed break. However, buying one cheeseburger every day for the next 25 years could lead to several missed opportunities. Aside from the missed opportunity for better health, spending that $4.50 on a burger could add up to just over $52,000 in that time frame, assuming a very achievable 5% ROAR. This is a simple example, but the core message holds for a variety of situations. It may sound like overkill to think about opportunity costs every time you want to buy a candy bar or go on vacation. But opportunity costs are everywhere and occur with every decision made, big or small. What is a simple definition of opportunity cost? Opportunity cost is often overlooked by investors. In essence, it refers to the hidden cost associated with not taking an alternative course of action. If, for example, a company pursues a particular business strategy without first considering the merits of alternative strategies available to them, they might fail to appreciate their opportunity costs and the possibility that they could have done even better had they chosen another path. Is opportunity cost real? Opportunity cost does not show up directly on a company's financial statements. Economically speaking, though, opportunity costs are still very real. Yet because opportunity cost is a relatively abstract concept, many companies, executives, and investors fail to account for it in their everyday decision-making. What is an example of opportunity cost? Consider the case of an investor who, at age 18, was encouraged by their parents to always put 100% of their disposable income into bonds. Over the next 50 years, this investor dutifully invested $5,000 per year in bonds, achieving an average annual return of 2.5% and retiring with a portfolio worth nearly $500,000. Although this result might seem impressive, it is less so when one considers the investor's opportunity cost. If, for example, they had instead invested half of their money in the stock market and received an average blended return of 5%, then their retirement portfolio would have been worth more than $1 million. How do you determine opportunity cost? The downside of opportunity cost is it is heavily reliant on estimates and assumptions. There's no way of knowing exactly how a different course of action may have played out financially. Therefore, to determine opportunity cost, a company or investor must project the outcome and forecast the financial impact. This includes projecting sales numbers, market penetration, customer demographics, manufacturing costs, customer returns, and seasonality. This complex situation pinpoints the reason why opportunity cost exists. It may not be immediately clear to a company the best course of action. However, after retrospectively assessing the variables above, they may further understand how one option would have been better than the other, and they have incurred a loss due to opportunity cost. Opportunity cost. The concept of the cost of money has its basis, as does the subject of finance in general, in the time value of money. The time value of money is the value of money taking into consideration the interest earned over a given amount of time. If offered a choice between $100 today or $100 in a year's time, and there is a positive real interest rate throughout the year, a rational person will choose $100 today. This is described by economists as time preference. Time preference can be measured by auctioning off a risk-free security, like a U.S. Treasury bill. If a $100 note, payable in 1 year, sells for $80 now, then $80 is the present value of the note that will be worth $100 a year from now. This fee paid as compensation for the current use of assets is known as interest. In other words, the concept of interest describes the cost of having funds tied up in investments or savings. Furthermore, the time value of money is related to the concept of opportunity cost. The cost of any decision includes the cost of the most foregone alternative. The cost of money is the opportunity cost of holding money in hands instead of investing it. The trade-off between money now, holding money, and money later, investing, depends on, among other things, the rate of interest that can be earned by investing. An investor with money has two options: to spend it right now or to save it. The financial compensation for saving it as against spending it is that the money value will accrue through the compound interest that he will receive from a borrower, the bank account or investment in which he has the money. Describe the concept of opportunity cost. Defining interest rate. An interest rate is the rate at which interest is paid by a borrower for the use of money that they borrow from a lender. Key points. In the U.S., the Federal Reserve, often referred to as the Fed, implements monetary policies largely by targeting the federal funds rate. Expansionary monetary policy is traditionally used to try to combat unemployment in a recession by lowering interest rates in the hope that easy credit will entice businesses into expanding. Contractionary monetary policy is intended to slow inflation in hopes of avoiding the resulting distortions and deterioration of asset values. Crowding out is a phenomenon occurring when expansionary fiscal policy causes interest rates to rise, thereby reducing investment spending. Key terms. Monetary policy, the process by which the monetary authority of a country controls the supply of money, often targeting a rate of interest for the purpose of promoting economic growth and stability. An interest rate is the rate at which interest is paid by a borrower for the use of money that they borrow from a lender. Changes in interest rate levels signal the status of the economy. As a vital tool of monetary policy, interest rates are kept at target levels taking into account variables like investment, inflation, and unemployment for the purpose of promoting economic growth and stability. In the U.S., the Federal Reserve, often referred to as the Fed, implements monetary policies largely by targeting the federal funds rate. This is the rate that banks charge each other for overnight loans of federal funds, which are the reserves held by banks at the Fed. Monetary policies are referred to as either expansionary or contractionary. Expansionary policy is traditionally used to try to combat unemployment in a recession by lowering interest rates in the hope that easy credit will entice businesses into expanding. An expansionary policy increases the total supply of money in the economy more rapidly than usual. Contractionary policy is intended to slow inflation in hopes of avoiding the resulting distortions and deterioration of asset values. Contractionary policy increases interest rate levels by expanding the money supply more slowly than usual or even shrinking it. Most central banks around the world assume and expect that lowering interest rates, expansionary monetary policies, would produce the effect of increasing investments and consumptions. However, lowering interest rates can sometimes lead to the creation of massive economic bubbles when a large amount of investments are poured into the real estate market and stock market. Crowding out is a phenomenon occurring when expansionary fiscal policy causes interest rates to rise, thereby reducing investment spending. That means increase in government spending crowds out investment spending. This change in fiscal policy shifts equilibrium in the goods market. A fiscal expansion increases equilibrium income. If interest rates are unchanged, an increase in the level of aggregate demand will follow. This increase in demand must be met by rise in output. With this increase in equilibrium income, the quantity of money demanded is higher. Because there is an excessive demand for real balances, the interest rate rises. Firms' planned spending declines at higher interest rates. Thus, the aggregate demand falls. The adjustment of interest rates and their impact on aggregate demand dampen the expansionary effect of the increased government spending.